Hey everyone, welcome back to Finance Kida, your go-to channel for finance. If you haven't already, make sure to check out our previous videos where we dive deep into various interview topics. Today, we're focusing on a niche but super important area in investment banking, product control or PC. This is a role that's often overlooked, but trust me, it's crucial for the smooth functioning of trading desks. So, whether you're preparing for an interview or just curious about this field, you're in the right place. And don't forget to like, share, and subscribe. You can speed up the video, watch it a couple of times before your interview, and definitely share it with your friends who might find it helpful. Now, let's get into it. What is the role of a product controller in an investment bank? A product controller acts as a bridge between the trading desks and the finance department. They are responsible for ensuring that the financial products traded by the bank are accurately valued and reported. This involves a lot of reconciliation, financial reporting, and analysis. Essentially, they ensure that what the traders believe they've made or lost aligns with the bank's financial statements. It's a role that requires strong analytical skills and a good understanding of financial products. Why is product control important in investment banking? Product control is vital because it helps maintain the integrity of financial reporting. In an industry where millions can be made or lost in seconds, having accurate P&L, profit and loss reporting is crucial. It ensures that the bank's financial health is accurately portrayed to stakeholders and regulators. Moreover, it helps in risk management by providing insights into the performance of various trading strategies and products. Can you explain the daily responsibilities of a product controller? Absolutely. A day in the life of a product controller usually starts with reviewing the daily P&L reports from the trading desks. They analyze the numbers, look for any discrepancies, and ensure that everything aligns with the bank's financial records. They also perform reconciliations between the front office and back office, ensuring that all trades are accurately reflected. Additionally, they might be involved in preparing reports for senior management, conducting variance analysis, and sometimes even working on valuation adjustments. How do you manage the P&L reporting process for trading desks? Managing the P&L reporting process involves a few key steps. First, you gather the trading data from various sources. Then you verify the accuracy of this data by cross-referencing it with the trading systems. Once you have a clear picture, you prepare the P&L reports and distribute them to the relevant stakeholders. It's important to communicate any significant variances and provide explanations for them. Regular meetings with traders can also help clarify any unusual movements in the P&L. How do you ensure the accuracy of daily P&L reporting? Ensuring accuracy is all about diligence and attention to detail. You need to have robust processes in place for data collection and verification. Regular reconciliations between the trading and finance systems are essential. Additionally, implementing checks and balances, such as having a second pair of eyes review the reports, can help catch errors before they become an issue. It's also crucial to stay updated on any changes in trading strategies or financial products, as these can impact the P&L. What are some common challenges faced by product controllers, and how do you address them? One common challenge is dealing with complex financial instruments, which can be difficult to value. To tackle this, product controllers often rely on models and market data, but it's essential to continuously validate these models. Another challenge is managing large P&L swings, which can happen due to market volatility. Communication is key here. Being transparent with traders and management about the reasons behind these swings can help mitigate concerns. What are the different types of financial products you've worked with? In product control, you typically deal with a variety of financial products, including equities, fixed income, derivatives, and commodities. Each of these products has its own valuation techniques and risk profiles. For example, equities are generally more straightforward to value based on market prices, while derivatives can be more complex due to their dependence on underlying assets. How do you value financial products like bonds, options, or swaps? Valuing financial products can vary significantly. For bonds, you typically look at the present value of future cash flows, discounted at the relevant interest rate. Options, on the other hand, can be valued using models like the Black-Scholes model, which considers factors like the underlying asset price, strike price, time to expiration, and volatility. Swaps are usually valued based on the net present value of the expected cash flows from the swap agreement. Can you explain the differences between exotic and vanilla derivatives? Sure. Vanilla derivatives are standard contracts with straightforward payoffs, like plain vanilla options or futures. Exotic derivatives, however, have more complex features and payoffs, making them less liquid and harder to value. For instance, a barrier option is an exotic derivative that only comes into existence or is extinguished if the underlying asset hits a certain price. The complexity of exotic derivatives can lead to unique challenges in product control, especially around valuation and risk management. How do you calculate the fair value of a derivative product? Calculating the fair value of a derivative involves using models that take into account various factors. For options, you might use the Black-Scholes model, while for interest rate swaps, you discount the expected cash flows using the relevant yield curve. The key is to ensure that the model accurately reflects market conditions and the specific characteristics of the derivative in question. How do interest rate movements affect the valuation of fixed income products? Interest rate movements have a direct impact on the valuation of fixed income products. When interest rates rise, the value of existing bonds typically falls as new bonds are issued at higher rates, making the older bonds less attractive. Conversely, when interest rates fall, existing bonds become more valuable. This relationship is crucial for product controllers as they need to continuously monitor interest rate trends and adjust their valuations accordingly. What are the key risks associated with derivatives trading? Derivatives trading comes with several risks, including market risk, credit risk, liquidity risk, and operational risk. Market risk arises from fluctuations in market prices, while credit risk relates to the potential default of a counterparty. Liquidity risk is the risk of not being able to sell a derivative quickly enough without impacting its price. Operational risk involves failures in processes or systems that can lead to losses. Product controllers need to be aware of these risks and work closely with risk management teams to mitigate them. Can you explain the Greeks delta, gamma, vega, theta, and their importance in options trading? The Greeks are essential metrics in options trading that help traders understand how different factors affect the price of options. Delta measures the sensitivity of an option's price to changes in the price of the underlying asset. Gamma measures the rate of change of delta, providing insight into how delta will change as the underlying price changes. Vega measures the sensitivity of the option's price to changes in volatility, while theta measures the time decay of the option's price as it approaches expiration. Understanding these Greeks helps product controllers and traders manage risk and make informed trading decisions. What is the difference between mark-to-market and mark-to-model valuation methods? Mark-to-market valuation involves using current market prices to value financial instruments, which provides a real-time snapshot of their worth. Mark-to-model, on the other hand, relies on mathematical models to estimate the value of financial instruments, particularly when market prices are not available or reliable. While mark-to-market provides transparency and accuracy, mark-to-model can be necessary for illiquid or complex products. Product controllers often need to justify their valuation methods, especially when using mark-to-model approaches. What is the process for reconciling P&L between front office trading and back office finance? Reconciling P&L between the front office and back office involves several steps. First, you gather data from both sides, ensuring that you have the same trading records. Next, you compare the P&L figures, looking for discrepancies. If there are differences, you'll need to investigate the reasons behind them, which could range from data entry errors to differences in valuation methods. Regular communication between the front and back office is essential to ensure that everyone is on the same page and to address any issues promptly. What are independent price verification (IPV) and its importance in product control? Independent price verification (IPV) is a critical process in product control that involves verifying the prices used for valuing financial instruments. This is important because it helps ensure that the valuations are fair and accurate, reducing the risk of misreporting and financial losses. IPV typically involves comparing the prices obtained from internal models with market prices or prices from independent sources. It's a key part of the controls that help maintain the integrity of the financial reporting process. How do you handle P&L attribution for complex financial instruments? P&L attribution for complex financial instruments can be quite challenging due to their intricate nature. The key is to break down the P&L into its components, identifying the factors that contributed to gains or losses. This might involve analyzing the impact of market movements, changes in volatility, or shifts in interest rates. By understanding these drivers, product controllers can provide clearer explanations to management and stakeholders about the performance of these instruments. What are valuation adjustments, for example, CVA, DVA, FVA, and how are they applied to P&L? Valuation adjustments are necessary to account for various risks associated with financial products. Credit valuation adjustment, CVA, reflects the risk of counterparty default, while debit valuation adjustment, DVA, accounts for the bank's own credit risk. Funding valuation adjustment, FVA, considers the costs associated with funding the positions. These adjustments are applied to the P&L to provide a more accurate picture of the true economic value of the financial instruments, ensuring that all relevant risks are considered. How do you handle large P&L swings, and how would you explain them to management? Handling large P&L swings requires a thorough analysis to identify the root causes. This might involve looking at market conditions, trading strategies, and any significant events that could have impacted the P&L. When explaining these swings to management, it's important to be transparent and provide a clear narrative. Use data and visuals to support your explanation, and be prepared to discuss any potential implications for future trading strategies. Clear communication can help build trust and confidence in the product control process. What is bid offer adjustment, and how do you account for it? Bid offer adjustment refers to the need to account for the difference between the buying, bid, and selling offer prices of financial instruments. This adjustment is important because it reflects the true cost of trading and can impact the P&L. In product control, you would typically account for this adjustment by incorporating it into the valuation process, ensuring that the P&L reflects the net position after considering the bid-offer spread. How do you validate the prices of illiquid or thinly traded products? Validating the prices of illiquid or thinly traded products can be tricky. One approach is to use market data from similar instruments or comparable transactions to estimate a fair value. You might also rely on pricing models that take into account the specific characteristics of the product. Additionally, independent price sources or broker quotes can provide valuable insights. It's essential to document your validation process thoroughly, as this will be important for audits and compliance. What is meant by reserves in product control, and why are they important? Reserves in product control refer to the funds set aside to cover potential losses or risks associated with financial products. These reserves are crucial for maintaining the financial stability of the bank and ensuring that it can absorb unexpected losses. They serve as a buffer against market volatility and help in risk management. Product controllers must regularly review and adjust reserves based on changing market conditions and the bank's risk appetite. What role does a product controller play in managing financial risks, such as market, credit, and operational risks? Product controllers are like the safety nets of the trading floor. They ensure that the financial risks associated with trading activities are properly monitored and managed. Market risk involves the potential losses due to market fluctuations, while credit risk is about the possibility of a counterparty defaulting on a deal. Operational risk, on the other hand, stems from failures in processes, systems, or people. A product controller assesses these risks and implements controls to mitigate them, ensuring that the investment bank operates smoothly and stays compliant with regulations. Moving on to our next question, how do you ensure strong controls over trading activities to avoid financial or operational risks? Strong controls start with robust processes. Product controllers establish clear policies and procedures for trading activities, ensuring that everything is documented and adhered to. They also implement regular audits and reconciliations to catch any discrepancies early. By maintaining a solid system of checks and balances, they can identify potential issues before they escalate into significant problems. Now, let's talk about a crucial aspect of product control. What is the importance of segregation of duties between the front office and product control? Segregation of duties is vital for preventing fraud and errors. By separating the functions of trading, front office, from those of product control, you create an environment where checks and balances can thrive. This means that the traders who execute trades are not the same individuals who are responsible for validating and reporting those trades. This separation helps to ensure that no one person has too much control over the process, which in turn reduces the risk of mistakes or malicious activities. Next up, how do you identify and escalate issues related to control failures or process inefficiencies? Identifying issues often comes down to vigilant monitoring and open communication. Product controllers need to be proactive in their approach. They should regularly review reports, perform reconciliations, and be in touch with the front office to spot any red flags. When issues are identified, it's crucial to escalate them promptly to senior management or relevant departments. This way, you can ensure that corrective actions are taken before these issues lead to significant financial repercussions. Next up, how do you identify and escalate issues related to control failures or process inefficiencies? Identifying issues often comes down to vigilant monitoring and open communication. Product controllers need to be proactive in their approach. They should regularly review reports, perform reconciliations, and be in touch with the front office to spot any red flags. When issues are identified, it's crucial to escalate them promptly to senior management or relevant departments. This way, you can ensure that corrective actions are taken before these issues lead to significant financial repercussions. Let's dive into a technical topic. What is value at risk (VAR) and how is it used in product control? Value at risk or VAR is a statistical measure that estimates the potential loss in value of a portfolio over a defined period for a given confidence interval. In product control, VAR is used to assess the market risk of trading activities. It helps product controllers understand how much money they could potentially lose in adverse market conditions. This insight allows them to implement risk management strategies to mitigate potential losses. Next question. How do you perform a scenario analysis or stress test on a trading book? Scenario analysis and stress testing involve simulating different market conditions to see how a trading book would perform. You create hypothetical scenarios such as a sudden drop in market prices or a spike in interest rates and analyze how these changes would impact the portfolio. By doing this, product controllers can identify vulnerabilities and prepare for potential adverse situations, ensuring that the bank is well equipped to handle market shocks. Now let's talk about accounting. How do you account for different financial products on the balance sheet? Different financial products have their own accounting treatments based on their characteristics. For example, derivatives are typically recorded at fair value, while loans might be recorded at amortized cost. It's essential for product controllers to understand the specific accounting standards that apply to each product, whether it's IFRS or US GAAP, and ensure that these are accurately reflected on the balance sheet. Speaking of accounting, what is the difference between realized and unrealized P&L? How do you account for each? Realized P&L refers to the profits or losses that have been actually incurred through completed transactions, like selling a security. Unrealized P&L, on the other hand, represents the potential profit or loss on open positions that haven't been sold yet. In accounting, realized P&L is recognized in the income statement, while unrealized P&L is usually recorded in other comprehensive income until the position is closed. Let's move on to a more technical aspect. Can you explain the accounting treatment for derivatives under IFRS or US GAAP? Under both IFRS and US GAAP, derivatives are generally recognized at fair value on the balance sheet. Changes in fair value are recognized in profit or loss unless the derivative is designated as a hedging instrument, in which case different accounting treatments apply based on the type of hedge. It's crucial for product controllers to ensure compliance with these standards to accurately report the financial position of the bank. Next, how do you handle hedge accounting and what are the criteria for applying it? Hedge accounting is a way to match the timing of gains and losses on hedging instruments with the losses and gains on the hedged items. To apply hedge accounting, you need to meet specific criteria such as documenting the hedging relationship and demonstrating that the hedge is effective. This involves a lot of meticulous record keeping and analysis to ensure that the hedge is serving its intended purpose. Now let's discuss the differences between trading book and banking book accounting. The trading book consists of financial instruments that are held for short-term trading purposes, while the banking book includes assets that are intended to be held for the long term. The accounting treatment also differs. Trading book instruments are typically marked to market, while banking book instruments may be recorded at amortized cost. Understanding these differences is critical for product controllers to accurately report and manage the bank's financial position. What about managing month-end and year-end financial closing in product control? Month-end and year-end closings are crucial periods for product controllers. They involve ensuring that all transactions are accurately recorded, reconciled, and reported. This process requires meticulous attention to detail and collaboration with various departments, including finance and risk management. Product controllers need to establish a clear timeline and checklist to ensure that all tasks are completed on time, minimizing the risk of errors. Now let's talk about the treatment of dividends and interest income in the P&L. Dividends and interest income are typically recognized in the profit and loss statement when they are earned. For dividends, this means when the company declares them, while for interest income, it's recognized as it accrues over time. Product controllers must ensure that these incomes are accurately reflected in the financial statements to provide a true picture of the bank's profitability. What systems or tools have you used for P&L reporting and trade booking, like Murex, Calypso, or Summit? Product controllers often rely on specialized systems like Murex, Calypso, or Summit for P&L reporting and trade booking. These systems help automate processes, improve accuracy, and streamline reporting. Familiarity with these tools is essential for anyone looking to work in product control, as they play a significant role in managing the complexities of financial transactions. Next up is a crucial task. How do you handle reconciliations between front office systems and general ledger systems? Reconciliations are a critical control mechanism in product control. They involve comparing the data in the front office trading systems with the general ledger to identify any discrepancies. This process requires a keen eye for detail and a systematic approach to ensure that any differences are investigated and resolved promptly. Regular reconciliations help maintain data integrity and build trust between departments. How do you prioritize and handle multiple tasks in a fast-paced environment like product control? In a fast-paced environment, prioritization is essential. Product controllers often juggle multiple tasks, so it's important to have a clear understanding of deadlines and the impact of each task on the overall process. Using project management tools and creating to-do lists can help keep everything organized. Additionally, staying flexible and being able to adapt to changing priorities is crucial in this dynamic field. Can you give an example of when you identified an error in a P&L report and how did you resolve it? Identifying errors in P&L reports is a common challenge. For instance, I once noticed a significant discrepancy in the reported P&L that didn't match the trading activity. I traced the issue back to a data entry error in the trade booking system. After identifying the root cause, I collaborated with the IT team to correct the error and implemented additional checks to prevent similar issues in the future. This not only resolved the immediate problem, but also improved the overall accuracy of our reporting processes. How do you manage relationships between the front office, traders, and other departments, finance, risk? Building strong relationships between the front office and other departments is crucial for effective product control. This involves open communication, regular meetings, and fostering a collaborative environment. Product controllers should be approachable and willing to help traders understand the reporting process while also ensuring that risk and finance teams are kept informed about trading activities. By promoting teamwork, you can create a more cohesive and efficient working environment. Can you describe a time when you identified a discrepancy in P&L and how you resolved it? Absolutely. I remember a situation where I noticed a significant variance in the P&L report compared to the previous month. I conducted a thorough review and discovered that a few trades had been misclassified due to a coding error. I immediately flagged this with my team and worked with the traders to correct the classifications. We then updated the P&L report and communicated the changes to all relevant stakeholders. This experience underscored the importance of diligence in maintaining accurate records. How do you analyze and explain large P&L variances? Analyzing large P&L variances involves a systematic approach. First, you need to break down the P&L statement into its components, such as revenues, costs, and expenses. Then, compare current results with historical data to identify trends or anomalies. It's also helpful to collaborate with traders and risk managers to understand the reasons behind the variances. Once you have a clear picture, you can prepare a comprehensive explanation for senior management that highlights the key drivers of the variances. What methods do you use to investigate and resolve pricing or valuation issues? When it comes to pricing or valuation issues, a thorough investigation is essential. I usually start by reviewing the pricing models and methodologies used to value the instruments in question. If discrepancies arise, I cross-check prices with market data or consult with external pricing vendors. Once the issue is identified, I work with the relevant teams to implement corrective measures, whether that's adjusting the pricing models or updating the data sources used for valuations. Describe a situation where you had to implement a new process to improve P&L reporting accuracy. In one instance, we noticed that our P&L reporting process was prone to errors due to manual data entry. To address this, I led a project to automate the data extraction and reporting process. We worked with the IT department to develop a new system that integrated directly with our trading platform, allowing for real-time data updates. After implementing this new process, we saw a significant reduction in errors and an overall improvement in the accuracy and timeliness of our P&L reports. What are the key regulatory requirements that affect product control, such as Basel III and Dodd-Frank? Regulatory requirements like Basel III and Dodd-Frank have a significant impact on product control. Basel III focuses on improving the regulation, supervision, and risk management of banks, emphasizing capital adequacy and liquidity. Dodd-Frank, on the other hand, introduced comprehensive reforms to enhance transparency and reduce systemic risk in the financial system. Product controllers need to stay informed about these regulations and ensure that their processes and reporting comply with the latest requirements. How do you ensure compliance with regulatory reporting requirements in product control? Ensuring compliance with regulatory reporting requirements involves keeping up to date with the latest regulations and implementing robust reporting processes. This includes maintaining accurate records, conducting regular audits, and collaborating with compliance teams to ensure that all necessary information is reported in a timely manner. By establishing a culture of compliance and continuous improvement, product controllers can help their organizations meet regulatory expectations. Finally, can you explain the impact of new regulations such as MiFID II and the Volcker Rule on product control and the trading desk? New regulations like MiFID II and the Volcker Rule have reshaped the landscape of product control and trading desks. MiFID II enhances transparency and investor protection, requiring more detailed reporting and data management. The Volcker Rule restricts proprietary trading by banks, which directly impacts trading strategies and risk management practices. Product controllers must adapt to these changes by updating their processes, ensuring compliance, and providing support to traders navigating the new regulatory environment. And that wraps up our deep dive into product control interview questions. I hope you found this information helpful and engaging. Remember to check out our other technical interview videos in the description below. And don't forget to like, share, and subscribe to our channel for more finance knowledge. Good luck with your interviews, and until next time, keep learning and growing in your finance journey.